Hello, I'm Dennis Bacon, the Chief Investment Officer at Beyond Wealth Advisors. We'd like to welcome you to our economic outlook for May of 2021. We have a big announcement this month. Last month, we welcomed a new team joining our firm in Manhattan, Kansas. We have a new office in Manhattan, and we'd like to really welcome them. And more importantly, we'd like to welcome all of their clients, and hopefully they find our economic outlooks to be educational and beneficial. So as we look forward, kind of had some interesting news this morning. The payroll numbers came out much less favorable than what we had expected. The payroll numbers showed only about 266,000 new jobs added, and we were expecting, the market was expecting about 1 million new jobs. Also, the unemployment rate rose to 6.1%. We actually expected it to drop down to about 5.8%. Now, there's a lot of reasons why this may have happened, and it may just be an anomaly. A lot of the economists feel like it is a little bit of an anomaly. Maybe all the numbers aren't there, and there'll be some adjustments down the road. But some of the reasons why this probably happened is right now, because of the shortage of materials, a lot of companies just can't do the work that they have scheduled because they just can't get the materials to do the work. And secondly, there is a little bit of a shortage of skilled labor force in a lot of markets or portions of the economy that are growing, such as housing. So these may be a couple of things that are contributing to the less than robust expansion of our employment situation. We're going to continue to monitor that and look forward. We do expect that to kind of level itself out, and hopefully this was just a little bit of an anomaly. The stock market took it in stride, and we're not really down today as a result of that, not so good news. Another odd item that we wanted to kind of talk about today was inflation. A lot of people are talking about what does inflation look like going forward. A couple of things that we would want to tell you is just because the federal government is spending a lot of money, that does not necessarily mean there's a lot of inflation, nor does budget deficits mean there's a lot of inflation. Throughout the 80s, we ran fairly high budget deficits, about 5% over what GDP was, and during this time we actually had declining inflation rates. Now we know we were starting from a high level, but still it doesn't mean that that's going to happen. What we do expect is to see inflation tick up into the 2.5 to 3, maybe even as high as 4% over the next 2 or 3 years. But we really do not expect inflation like we saw in the late 70s, where we were having some double-digit inflation numbers. That just doesn't seem to be in the cards right now. Now that could change if there's some disruptive events, but again, we think the probability of that is pretty low, and the Federal Reserve is probably going to expand their target for inflation a little bit in the 2.5 to 3% range, and we still may exceed that a little bit. So these are things we're watching. They don't unfold in a week or even a month. So hopefully we will see that unfold over time and continue to keep you updated on that. As far as the markets go, we're still seeing a lot of oscillation between growth and value. It's kind of seen from week to week. It can be a little different on which one's in play. Technology is kind of taking a little bit of a lead here in the last few weeks. They had a few weeks where it was down. And there is a little bit of concern that some of the portions of the economy that are coming out of the COVID-induced recession, such as travel, lodging, vacation-oriented things, may be a little bit ahead of themselves and may see a little bit of a pullback. But overall, we think that the economy and the market is going forward at a fairly steady pace throughout the remainder of this year. Bonds do continue to present a bit of a problem as we continue to see that inflation rise. They very well will maybe hopefully just keep their value with the interest they're paying. Remember, a bad year in bonds is down a few points, where a bad year in the stock market is down a lot. And a good year in the stock market is what we kind of look for going forward. I think probably the biggest thing we would advise you to do is stay vigilant and watching what's going on in the news to make sure there's not any disruptive events that truly are impacting the economy. But we really look forward to a lot of stability going forward. And a lot of stability means you can take some time to enjoy a great summer in 2020.